Welcome back. Mondays on News 3 this morning. We try to get you up to date on what's happening on Wall Street, and last week was a pretty wild week in the market. And to help sort things out, this morning we're joined by Mr. David England, Associate Professor of Finance at John A. Logan College. Good morning, David. How are you?
I'm well, thank you.
Glad to have you here this morning. And I guess what really happened last week with the stock market? We've been, talking a lot about how kind of crazy it was.
Well, it was definitely a crazy week, and this week is maybe just as exciting. Let's first talk about what didn't happen. The sell-off wasn't caused by a false trade. You know, our public is not that naive. You don't say that you hit $1 million trade or $1 billion and say it was $1 million. That's just far-fetched. But what did happen and the selling didn't start on Thursday. In my classes, I've been showing my students as far back as April the 19th, the institutions started taking their profit. Matter of fact, we've had 4 huge days of profit taking since April the 19th. So the institutions are ones that move the market. So that was an advanced signal for some people to start to take their profits and these kinds of things. Now, let's put things in perspective. 45 minutes before the sell-off, the yen skyrocketed against the dollar. Now, nobody's talking about that, but that's the truth. So what that caused is that made a lot of the traders very, very, let's say, trigger finger, so to speak. And then at that point in time, we had 2 things that caused it: profit taking and program trading. So
how do these work then?
Well, profit taking, because we've had a huge rally since March of '09. Huge. The S&P was up over 77% before they started selling it off. So whenever you have this larger profit, people are going to start taking it, because Wall Street doesn't work on the buy and hold. We're going to buy it today and sell it 10 years from now hoping that it's up. So when they get their profits, they're going to take it. So what happened is the profit taking started, and then with the program trading. If everybody in the world that are traders have a computer on their desk, well, at that point in time, that means that there's many million traders out there domestically and globally that were hitting the sell button. So that's like calling fire in the traders' computers, and that's what set this up. And the program trading that makes it easy to trade was a downfall for many, because it just escalated and escalated. And then also the protection was not, the surge protection was already taken off on the New York Stock Exchange, but not on the other. So that caused a lot of problems.
So what comes next after what we've seen?
Well, part of this was, the finger pointing was because of Greece. Well, we've been talking about Greece for 60 days. Right. But what happens is Greece, at that point in time, weakens Europe. Anything that weakens Europe will weaken the United States, because we're so intertwined. Number one, because we have so many customers coming from that area, but also our banks are tied to that area, in a large part. Now, over the weekend, matter of fact, last night, there was over $1 trillion relief package.
Right. So how does that help our situation as well here with the U.S. market?
Temporarily, but it doesn't get to the root of the problem. Emily, the root of the problem is deficit spending. No matter where we are, whether it's on a county level, a state level, a national level, or a global level, economies can only sustain so long whenever you spend more money than what comes in. So yes, this is going to be very, very temporary. It's going to be interesting to see what happens. Now, this morning, the futures are up extremely high, higher than I've seen them in a long time. So it's going to be a question: is the big money at that point in time, after the prices get up, are they going to sell it off, or exactly what?
And real quickly, don't have a lot of time left, but any positive news?
Well, there's always positives, and the things that I talk, everything that's negative, there's positive opportunities. Number one, if the euro would, after it jumps up, if it continues to sell off, that means our dollar goes up. At that point in time, that will drive the energy and commodity ETFs and stocks down into buying zone, which I was buying last week whenever everybody else was selling. So there's going to be tremendous buys in the energy. Plus, last week, mortgage rates dropped again. So when the money goes out of the stocks, in the bonds, that drops the rate. So for people wanting to buy a house that didn't catch it the first time, or the second time, or the third time, or the fourth time, the mortgage rates they dropped last Friday. They're probably going to pop back up the first of the week, but anytime you can get a mortgage rate under 6%, 5.5%, that's fantastic. So there's plenty of opportunities out there. We just need to know where to look.
All right. Well, thank you so much, stock market analyst David England. We always like having you on here.
Well, thanks for having me.